Welcome to session 1 in lesson 2. In this session, you will learn the basic principles of efficient market hypothesis. The learning goals for session 2.1 are: you should be able to explain the random walks and the efficient market hypothesis. You know how competition impacts the source of efficiency, and students should be able to identify the different versions of efficient market hypothesis. Efficient market hypothesis. Maurice Kendall examined in 1953 if the assumption is correct that stock prices reflect the prospects of the firm. He found that he could identify no predictable patterns in stock prices. Prices seemed to evolve randomly. They were as likely to go up as they were to go down on any particular day, regardless of past performance. The data provided no way to predict price movements. It soon became apparent that random price movements indicated a well-functioning or efficient market, not an irrational one. New information, by definition, must be unpredictable. If it could be predicted, then the prediction would be part of today's information. Stock prices that change in response to new information also must move unpredictably. This is the essence of the argument that stock prices should follow a random walk, that is, that price changes should be random and unpredictable. A random walk would be the natural result of prices that always reflect all current knowledge. Impacts of the efficient market hypothesis. Do not confuse randomness in price changes with irrationality in the level of prices. If prices are determined rationally, then only new information will cause them to change. Therefore, a random walk would be the natural result of prices that always reflect all current knowledge. Indeed, if stock price movements were predictable, that would be evidence of stock market inefficiency, because the ability to predict prices would indicate that all available information was not already reflected in the stock prices. The notion that stocks already reflect all available information is referred to as the efficient market hypothesis. Cumulative abnormal returns before takeover attempts. The figure on the slide illustrates the response of stock prices to new information in an efficient market. The graph plots the price response of a sample of firms that were targets of takeover attempts. In most takeovers, the acquiring firm pays a substantial premium over current market prices. Therefore, announcement of a takeover attempt should cause the stock price to jump. The stock prices on the figure jumps dramatically on the day the news become public. However, there is no further drift in prices after the announcement date, suggesting that prices reflect the new information, including the likely magnitude of the takeover premium by the end of the trading day. Price movements before announcement can be explained by rumors or information leakage. Let's have a look at stock price reactions to CNBC reports. Even more dramatic evidence of rapid response to new information may be found in intraday prices. Patel and Wolfson showed that most of the stock price response to corporate dividend or earnings announcements occur within 10 minutes of the announcement. A nice illustration of such rapid adjustments is provided in a study by Bosses and Green, who track minute-by-minute stock prices of firms that are featured on CNBC's midday calls. The top line is the average price movement of stocks that receive positive reports, while the bottom line reports returns on stocks with negative reports. Note this that the top line levels off, indicating that the market has fully digested the news within 5 minutes of the report. The bottom line levels off within about 12 minutes. Efficient market hypothesis and competition. When information is costly to uncover and analyze, one would expect investment analysis calling for such expenditures to result in an increased expected return. This point has been stressed by Grossman and Stiglitz. They argue that investors will have an incentive to spend time and resources to analyze and uncover new information only if such activity is likely to generate higher investment returns. Competition among these may well lead to highly paid aggressive analysts, ensuring that as a general rule, stock prices ought to reflect available information regarding their proper levels. Information is often said to be the most precious commodity on Wall Street, and the competition for it is intense. Information advantage leads to better performance. Let's distinguish between the different versions of the efficient market hypothesis. First, the weak form of the efficient market hypothesis asserts that stock prices reflect all the information that can be derived by examining market trading data such as the history of past prices and trading volume. A strong body of evidence supports weak form efficiency in the major US security markets. For example, test results suggest that technical trading rules do not produce superior returns after adjusting for transaction costs and taxes. Second, the semi-strong form states that a firm's stock price reflects all publicly available information about a firm's prospects. Examples of publicly available information are company annual reports and investment advisory data. Evidence strongly supports the notion of semi-strong efficiency, but occasionally studies identifying market anomalies such as the small firm in January or book-to-book market effects and events stock market crash of October 19 in 1987 are inconsistent with this form of market efficiency. There is a question concerning the extent to which these anomalies result from data mining. Third, the strong form of the efficient market hypothesis holds that current market prices reflect all information, whether publicly available or privately held, that can be relevant to the valuation of the firm. Empirical evidence suggests that strong form efficiency does not hold. If this form were correct, prices would fully reflect all information. Therefore, even insiders could not earn excess returns. But the evidence is that corporate officers do have access to pertinent information long enough before public release to enable them to profit from trading on this information. Efficient market hypothesis in the real world. Let's discuss a few market scenarios which are considered to be either consistent with or a violation of the efficient market hypothesis. Statement 1. Nearly half of all professionally managed mutual funds are able to outperform the S&P 500 in a typical year. This statement is inconsistent with the efficient market hypothesis. Based on pure luck, half of all managers should beat the market in any year. Now let's go to statement 2. Money managers who outperform the market on a risk-adjusted basis in 1 year are likely to outperform the market in the following year. This statement is also inconsistent with the efficient market hypothesis. This would be the basis of an easy money rule: simply invest with last year's best managers. As often referred, historical outperformance is no guarantee for future outperformance. Let's continue on the discussion of the previous slide. Statement 3. Stock prices tend to be predictable more volatile in January than in other months. This statement is consistent with the efficient market hypothesis. In contrast to predictable returns, predictable volatility does not convey a means to earn abnormal returns. Statement 4. Stock prices of companies that announce increased earnings in January tend to outperform the market in February. This statement is inconsistent with the efficient market hypothesis. The abnormal performance ought to occur in January when earnings are announced. So the question is, what are the roles of portfolio managers in efficient markets? Portfolio managers have several roles and responsibilities even in perfectly efficient markets. The most important responsibility is to identify the risk-return objectives for a portfolio given the investor's constraints. In an efficient market, portfolio managers are responsible for tailoring the portfolio to meet the investor's needs, rather than to beat the market, which requires identifying the client's return requirements and risk tolerance. Rational portfolio management also requires examining the investor's constraint, including liquidity, time horizon, laws and regulations, taxes, and unique preferences and circumstances such as age and employment. We are at the end of session 2.1. After having carefully studied the slides and relevant chapters in the book, please start with the review questions.